Good evening, students. I am CA Dimple Goyal, Board of Studies Faculty for Direct Tax and International Taxation. And along with me, there is CA Prerna Pishori, your faculty for final paper for Direct Tax and International Taxation. Hi, Prerna.
Yeah, sorry, I was in mute. Good evening.
Yes. So, Prerna ma'am will be take through the classes for this November live virtual classes for final paper for Direct Tax Laws and International Taxation for November 2024 examination. But before that, I just hand over to her. I'll just brief you regarding the what are the relevant amendments, what are the which finance act is applicable for November 2024 examination, which study material, and from where you have to read all these things from the institute website or BOS knowledge portal. So this is the BOS knowledge portal. You can access to this from the institute website. After institute website, you have to go to the BOS knowledge portal and you can get access to this BOS knowledge portal where you will get all the study material, mock test paper, revision test paper, saransh, everything you will get at this page. Or you can download the BOS mobile app also where all the materials will be available to you in your mobile. So regarding that for November 2024 examination, the provisions of direct tax laws as amended by Finance Act 2023 will be applicable for November 2024 examination. The cutoff date will be 30th April 2024 for the November 2024 examination. So the study material, which is already hosted on the institute website, and this study material, the edition of the study material is your October 2023 edition. So October 2023 edition of the study material of final paper for direct tax laws and international taxation will be applicable for the November 2024 examination. So students, you have to read with that study material only. There will be no separate study material for November 2024 examination. But along with this study material, you have to update yourself with the significant notification and circular or legislative amendments or judicial update, which is also hosted on the Institute BOS Knowledge portal. If you go through the study material page, you will find in the study material that paper 4 direct tax laws in international taxation study material is there. After that, there is a stat update for November 2024 examination. In this statutory update, whatever the significant notification and circular which is not up to 30th April 2024, which is not covered in your October 2000 edition of the study material, that is given in this statutory update, as well as your judicial update. Judicial update for November 2024 examination will be hosted on the BS Knowledge portal maximum by tomorrow. And in that judicial update, all the judicial ruling which is relevant for you up to 30th April 2024, which is not covered in your study, October 2023 edition of the study material, that will be in the judicial update for November 2024 examination. So for this statutory update and judicial update, you have to very much refer it for November 2024 examination along with the study material. And Prerna will also take this statutory update and judicial update in the last class and will brief you about all the significant notification, circular and judicial rulings. Regarding the LVC classes, since LVC classes, live virtual classes for the May 24 examination has been already conducted and the same study material, same Finance Act is applicable for the November 2024 examination. Thus, classes is already after login to the BOS knowledge portal, you can see your recorded lecture for November 2024 examination. All the classes which were for the May 2024 examination, this is already also available in for November 2024 batch. So if you see paper wise, so if you see, you have to log in it from your registration number, your SRO, NRO, whatever it is, and you have to enter your date of birth. So after login to the BOS Knowledge Portal, you will see there is a recorded lecture current batch for November 2024 examination. So you can find your all the recorded lectures which is relevant for the November 2024 examination. Subject wise, paper wise is already segregated here. If I see for the direct tax laws and international taxation, you can find all your recorded lectures which is relevant for November exam. It's already available there. Apart from that, Prerna will take some classes in which she will brief you regarding the relevant provision, which are the significant provision, and she will take some question also based on that provision and will try to solve the problems and make the session interactive and understanding for your purpose. So I'll just request all of you students to participate in maximum number of capacities through the Zoom link, because in the Zoom link you can directly connect with the faculty and you can share your concern and your problems to the faculty by coming online. So in this knowledge portal, you can see there is an option of MCQ paper practice. In that MCQ paper practice, MCQs, independent MCQs as well as case scenario based MCQ for your practice is also uploaded here. So you can start your practice session and you can choose whether you want to go for independent MCQ or case scenario based MCQ. So for that, there is an option of practice also. You will see your progress also, okay, how much you have given the correct option and how much is completed status. So it is like a progress report, ki how much you have completed and what is your percentage of correct option also. So you can get the benefit of this because your 30% exam is of case scenario based MCQ. So you can practice through this paper practice for your MCQ portion. So regarding your notes, that is, I hope you all are aware that you can download your notes and assignment for the live virtual classes from this section. And mock test paper also you can download it, which is already hosted for May 24 examination. That is also relevant for November 2024 examination. And separately, the new schedule for November 2024 examination, you can get the mock test paper as and when it conducted. So for the live class, I'll just hand over the class to Prerna. So just she will take you brief to the some relevant provision and then she will start taking the questions also. Over to you, Prerna.
Thank you, ma'am. Good evening, students. Welcome to this session. Students, as you are aware, and as Dimple ma'am also briefed you, these are going to be the revision lectures and problem-solving classes specifically. So here, our approach is that you should have already watched the prior lectures, but just in case, if you have not watched, I would request you to watch those lectures and then sit for the live sessions, because then you would have a kind of revision of those classes. Here in this particular session, that 6 sessions that we have, what we are going to do, students, is that we are going to quickly recap all the provisions that you would have studied. Let's say, for example, we start with the basic concepts, PGBP, all of that, and we will start solving the questions around that. So we will first have a quick glimpse of the entire portion in first half an hour to 45 minutes to 1 hour. And then we will start solving the questions where you will have to give me the answers, so that what would happen is that once you start solving, you would have an idea, you would have a practice as to how you have to solve for your examination. So let's get quickly started. I'll just share my screen, students. So I'll start quickly with the basic concepts. This is just revision. You have to watch the detailed videos of the prior lectures that we have conducted already. So these are just revision and we'll quickly revise the important point over here. So first we'll start with the section 4. What does section 4 say, students? It says that where any central act enacts income tax shall be charged for any assessment year at the rates, income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provisions for the levy of additional income tax of this act in respect of the total income of previous year of every person. Now, what it tries to say is that where as per the Finance Act or the Income Tax Act, the rates are given, then on the total income of the previous year of every person, the income tax shall be charged at those rates. So what is important over here is that the income tax is chargeable on the total income of the every person. So the charging section charges on the total income of every person which is earned during the previous year shall be charged or assessed to tax in the next assessment year. Now, what is total income? Total income is your total amount of income referred to in section 5. 245 says total amount of income. Income is defined under section 224 in the inclusive manner. And total amount of income referred to in section 5. What is referred to in section 5? It is the scope of total income. Section 5 is the scope of total income. For ROR, global income is taxable wherever accruing or arising. For RNOR, only the Indian sourced income is taxable. All income received or deemed to be received in India, or income from a business or profession which is carried on outside India but controlled from India. So for RNOR, that is the scope of total income. For NR, income accruing, arising, deemed to accrue or arise, or income received or deemed to be received in India. That is the scope of total income under section 5. Plus computed in the manner laid down under this act. So 245 says total amount of income referred to in section 5 and computed in the manner laid down under this act. So how is the computation laid down in this act? We have to refer to the heads of total income. So salary 15 to 17, IFHP 22 to 27, PGVP 28 to 44, CG 45 to 55, IE post 56 to 58, then clubbing chapter 6A set off of losses. So that is your total income of a person. Person is defined under 231 to include individual, HUF, AOP, BOI, firm, company and local authority. Then tax rate, there are general tax rates, there are special tax rates. General tax rates come from the Finance Act 2023, which is your part 3 and part 1. Isn't it? So Finance Act 2023 will give you the first part of it, will give you the rates of the income tax. Special rates are given in the Income Tax Act in specific section. For example, 111A for STCG, 112, 112A for long-term capital gain, 115 for the non-resident taxation. So those are the special rates of taxation, isn't it? So that is your first charging section, which is the total income into the tax rate will give you the income tax, which will be charged in the previous year. So total income of the previous year is charged or assessed to tax in the assessment year. However, there are exceptions to that. What are the 5 exceptions? Shipping business of a non-resident under 172, any person leaving India, person likely to transfer property to avoid tax, AOP or BOI which is formed for specific purpose, or discontinued business. In all these cases, the total income is assessed in the previous year itself, not in the assessment year. So total income of the previous year is assessed to tax in the previous year itself, right? Then we will come up with the definition of the company. Now, what is company? Person includes company. Company is defined under 217. 217 says company means an Indian company or a foreign company, right? So now in this particular case, under 217, you have the definition of the company. So there are different types of company. All these companies are not included under section 217. Only 217 includes only limited aspect. But there are different types of company. And why is it important to distinguish these companies? It is very, very important to understand because it will impact the tax rate. So company means an Indian company or a body corporate incorporated outside India. So that is your foreign company, right? It just says that. But Indian company means undefined under 226, which means formed and registered as per the Companies Act 2013 or 1956, right? Domestic company is there. Now, what is a domestic company? There is a difference between the Indian company and domestic company. Domestic company is defined under 222A, which says it means an Indian company or any company which could be a foreign company which has made the arrangements for declaration and payment of dividend within India out of its taxable income. So that is your domestic company. Now, why is it important to have a distinction between a domestic company? Domestic company, we have different provisions applicable only to the domestic company itself, right? Also, the tax rate for a domestic company and a foreign company is different. For a foreign company, we will see what is the tax rate. For the domestic company, we'll see what is the tax rate. But having said that, as I said, there is a distinction. We will have to understand that. Then you will have the resident company. Resident company, which is the Indian company or a foreign company having a poem in India. Then there is a foreign company, which is defined under 223A. which is company which is not a domestic company. So any company which is not a domestic company, as I told you, what is domestic company? Domestic company is the Indian company, or the foreign company can also be a domestic company, but it should have made the arrangements for declaration of the dividends out of its taxable income in India. What do we mean by the declaration and payment of dividends within India? What are those prescribed arrangements? So it should have maintained the share register in India at the principal place of business in India. The general meeting for declaring the dividends should have been held in India. The declared dividends are payable in India. So all of those means that it has made the arrangements for declaration of dividend in India. Then resident company is the company which is Indian company and a foreign company which is having a POEM in India. That is a resident company. Resident company's total income, global income is taxable in India. Resident companies' global income is taxable in India, whereas foreign companies only, if a foreign company is a non-resident company, then only the Indian sourced income or income received or deemed to be received in India is only taxable. Then we have something called as widely held company and closely held company. Widely held company means company in which public is substantially interested. Under 218 it is defined. It also means the government or RBI owned company, Section 8 company, company owned by the cooperative societies, listed company, private company or subsidiary of a listed company. So unlisted company or a private company which is subsidiary of a listed company is also the widely held company. Company in which public is not substantially interested is closely held company. So private companies or unlisted company which are not the subsidiary of listed companies are the closely held company. Now, why that distinction is important? Because there are provisions like deemed dividend, 5627B, which is angel tax, Section 68, Section 79, set off carry forward of losses, 179. These are only applicable to a closely held company and not to a widely held company. So these distinctions are very, very important. Okay. Now, coming to the tax rate determination. Now, we'll talk about first the tax rate determination. First, we'll go to the individual HUF, AOP, BOI, AOP, artificial juridical person. There are general tax rates and then there are concessional tax rate, which is now a default tax rate. So concessional tax rates under 115 BAC are the default tax rate. And if you want to opt out for that, then you will have to go for the general tax rate. Otherwise, the default tax rate will be the concessional tax rate, students. So in that particular case, what are my default tax rates? Up to 3 lakh, it is nil. 3 lakh to 6 lakh, it is 5%. 6 lakh to 9 lakh, it is 10%. 9 lakh to 12 lakh, it is 15%, and 12 lakh to 15 lakh, it is 20%, and greater than 15 lakh, it is 30%. However, if you want to claim this, then your total income will be without claiming the following exemptions or deductions. What are those? It is you cannot claim your leave travel concession under 10.5. You cannot claim your HRA under 10.13A. You will not be able to claim exemption for special allowances under 10.40. However, traveling and conveyance allowance is allowed. Transport allowance of 3,200 to handicapped is also allowed. So although all the special allowances which are under 1014 will not be allowed, but traveling and conveyance allowance is allowed. Then you will not be able to claim daily allowance or constituency allowance for MLA MP. Exemption for minor child under 1032, which is 1500 for club income of minor child, that will also be not allowed. You cannot claim tax holiday under section 10AA. You cannot claim entertainment allowance and PT under section 16. However, you can claim the standard deduction. Food coupon vouchers not allowed. So 50 per meal is not allowed. Interest on loan in respect of self-occupied property under 24B not allowed. The 2 lakh interest that you claim is not allowed. However, interest on loan on rental property will be allowed. Additional depreciation under section 32(1)(2)A not allowed. Normal depreciation you can claim. Then you cannot claim the specified deductions, which is 33AB for tea, coffee, rubber development, site restoration fund, scientific research, contribution to research associations for scientific research, statistical research, national laboratory, all of that you cannot claim. Contribution to Indian company for scientific research you cannot claim. What you can claim is scientific research expense related to your own business, including the expenses which are relating to the prior to commencement of business, and any capital expenditure for the scientific research will be allowed. Investment based deduction under 35AD, 35CCC not allowed. Chapter 6A deduction not allowed. What you can claim is employer contribution to NPS, which is 50,000, which is 80 CCD to your employee Deduction under 80JJAA for hiring the additional employees. Agnipat scheme, 80LA, those only you can claim. So only employer contribution to NPS under 80CCD2, Agnipat scheme, employee deduction under 80JJAA, 80LA, only that will be allowed. Set off and carry forward of losses related to those deductions will not be allowed. Set off and carry forward of losses if not pertaining to these deductions will be allowed. Set off of house property loss against any income will also not be allowed in case of the let out property. Are we clear? So set off of house property loss against any income will not be allowed. Unabsorbed depreciation relating to the additional depreciation will not be allowed. However, any other unabsorbed depreciation which is there, which is pertaining to the normal depreciation, that will still be allowed. Are we clear, student? So this is your optional, this is your default tax scheme. If you want to opt out for this particular scheme, then in that particular case, you need to opt out specifically if you are associated with the business or profession. Then in that particular case, before the due date of filing your ITR under 131 month, you have to opt out. So option applied then to all the subsequent years. Once you opt out, then it will apply to all the subsequent years. Can you go back again to 115 BAC? Yes, but only once. Only once you can go back again. So once you have opted out, again once you can only go back, and then it will apply to all other assessment year. Other than PGBP, every year before the filing of return of income, you will select as to whether you want to go with the old regime, which is an optional regime, or with this particular new regime, which is a default regime. Under the optional one, what are the tax rates? The up to 2.5 lakh, it is nil, 2.5 to 5, 5%, 5 to 10, 20%, and greater than 10 lakh, it is 30%. This is for the all the assessing. For resident individual greater than 60 years, less than 80 years, it is 3 lakh nil, 3 lakh to 5 lakh 5%, 5 to 10 20%, and greater than 10 30%. And for resident individual greater than 80 years up to 5 lakh, it is nil, 5 to 10 lakh, it is 20%, and greater than 10 lakh, it is 30%. So this is only for resident individual. Remember, yes or no? Fine. Any questions so far, students? You can put your questions in the chat boxes. You can put your questions and we will take it there and then itself. Are we clear? Any questions you have, you can ask. Yes, without set off of any loss under the default tax regime, without set off of any loss under the head house income from house property with any other head of income. So you will not be able to claim in case of let out property. If you have any loss, you will not be able to claim that. Fine. Then comes the rebate under 87A. Under the old regime, under the optional regime, rebate is available to a resident individual, which is 12,500 up to rupees if you have income up to rupees 5 lakh. And in the new regime, which is the default regime, you have 25,000 up to rupees 7 lakh if you have the income, but this is available only to a resident individual. What are the surcharges? Surcharge, which is total, if your total income is more than rupees 50 lakh and less than equal to rupees 1 CR, it is 10%. And if you have more than 1 CR, less than equal to 2 CR, you have 15%, including your LTCG, STCG or dividend, which is there. LTCG, STCG under the 112, 112A, 111A. If your total income is more than 2 crores, less than equal to 5 crore, excluding the LTCG, STCG or dividend. LTCG under 112, 112A and STCG under 111A. Then in that particular case, your surcharge will be 25%. If your total income is more than 5 crore, excluding LTCG, STCG and dividend, then in that case, the highest rate of surcharge is 37%, meaning on the LTCG under 112, 112A dividend, the highest surcharge will be 15%. Only on the other income, you have the 37%. For the for the new regime, your surcharge rates are, if your total income is more than 50 lakh, less than 1 CR, it is 10%. More than 1 CR, less than 2 CR, it is 5%, including the LTCG, STCG and dividend. If your total income exceeds 2 CR, under the new regime, the surcharge is only 25%. Under the old regime, the highest surcharge rate is 37%, students. But under the new regime, the highest surcharge rate is only 25%. And that too on the dividend LTCG under 111A, STCG under 111A, LTCG under 112A, the highest surcharge is 50%. So that is the difference between the new and the old regime. Now coming to a company, as I told you, there is a distinction between the company which is the domestic company and the foreign company. So what are the distinction? Under the domestic company, the general tax rate is students 30%. For the small companies, what are the small companies? The small companies are where the turnover or gross receipt in the previous year 21-22 is less than equal to 400 crore. In that particular case, your tax rate is 25%. For the manufacturing companies, they have an option to opt it for the 115BA rate, which is a concessional tax rate for manufacturing company which are into the manufacturing or electricity generation. The tax rate is 15%. Under the normal rate, the 30%, or the small companies, the surcharge is if your total income is more than 1 CR and less than equal to 10 CR, then in that particular case, it is 7%. If the total income is greater than 10 CR, it is 12%. However, for 115BAB, the surcharge is 10%. And cess is 4%. That the surcharge is flat irrespective of the level of total income. So that makes the tax to effective 17.16%. Now, what are the conditions? There are conditions over here. Conditions are that it should have the company set up and registered on or after 1/10/2019, but before 31st March 2024. There is a condition that the business should not be formed by splitting up or reconstruction of already existing business. There is a plant and machinery, so it should not be formed with the old plant and machinery. Now, there is an exclusion to that. The exception is that if the imported plant and machinery is used, if the imported second-hand plant and machinery is there, that is all right. So the condition is that it should not be formed with the old plant and machinery, but they have given some leeway. If you import the second-hand plant and machinery, that would not be considered as a second-hand plant and machinery, or if your value of the second-hand plant and machinery is less than 20% of the total value of the plant and machinery, it is fine. It will not be considered that the business is formed with second-hand plant and machinery. Then it should not be engaged in any other business other than the business of the manufacturing, production, and distribution. Now, business of manufacturing shall not include what it shall not include: development of computer software, mining, conversion of marble blocks, bottling of gas into cylinder, and printing of books or production of cinematographic film. Now, what are the conditions for the claiming of that 115BAB 15% tax rate or 17.16% tax rate? Total income is computed without deduction under 10AA if the unit is in SEZ. Additional depreciation under 3212A. Normal depreciation can be claimed. Investment allowance under 35AD. Tea, coffee, rubber development under 33AB. Site restoration fund under 33ABA. Scientific research deduction under 35. When you give contribution to a scientific research association or a statistical research association or a national laboratory or IIT or Indian company for scientific research, means you give it to any external person for scientific contribution, for scientific research, that will not be allowed to you as a deduction. What will be allowed to you as a deduction? If you incur the scientific research expenses relating to your own business, including prior to the commencement of your business, even any capital expenditure excluding land will be allowed to you as the deduction under the 35. Agricultural project deduction not allowed. Chapter 60 deduction not allowed. 80JJAA for new employees, 80M for intercorporate dividend, and 80LA for IFSC unit only will be allowed. Set off of losses and unabsorbed depreciation relating to the additional depreciation will not be allowed. Other than that, the set off and carry forward of losses will be allowed. Fine. You have to exercise this option before the first return filed before the due date under 139(1). And once the option is exercised, it cannot be withdrawn subsequently. If you have any other income, so the taxability of that income will be any other income which is not incidental to manufacturing or production or generation of electricity, that shall be taxed at 22% plus a surcharge of 10% plus a cess of 4%, meaning 25.168% without any deduction of expenditure or allowances. So any IFHP, IFOS, any other income that you have, you will tax at a gross basis of 25.168%. STTG on the non-depreciable asset and other than 111A, you will have 25.168%. So STCG on a non-depreciable asset and other than 111A, you will tax on 25.168% directly. What about the STCG on the depreciable asset? Then in that particular case, it will be at 25.168% itself. If it is not relating to manufacturing, if it's relating to manufacturing because it's a depreciable asset, then it will be taxed at a normal rate of 15%. So now if we go to 111A, 112A, that will be allowed. So income which is taxable at special rates will continue with that tax at special rate, 112, 112A, 111A. Those income, STCG, LTCG will be continued to be taxed at those rates itself. Even in the case of the individuals also, when you go for the 115 BAC. Are we clear? Then in that particular case, if there is a transaction between a company claiming 115 BAB and any other closely connected person, that will be considered as a specified domestic transaction, transfer pricing will be applicable. And in case there are any excess profits, that shall be taxable at the rate of 34.32%. Then MAT will not be applicable over here. Any non-fulfillment of conditions option would become invalid and normal provisions will apply. So if you're going for 115 BAB, you can go for 115 BAA. And if you have not fulfilled the condition, then you can go for 115 BAA rate still. Now, what is 115 BAA? 115 BAA again is a concessional optional tax rate of 22%. For other companies, surcharge is again flat 10%. Cess is 4%, which makes it to 25.168%. This is applicable to new as well as old companies. There is no condition for manufacturing, no condition for that the business should not be formed by reconstruction or with the old plant and machinery. All of those conditions are not there. Only conditions are that these deductions, which are similar to the 115 BAB, should not be claimed even under 115 BAA as well. And here you can exercise the option before the due date of filing of the return of income in any year. But once you have exercised the option, it cannot be withdrawn. Any other income which is there other than the normal income, business income, that will be continued to be taxable at 25.168% only, but there will not be any gross basis of taxation. Also here TP will not be applicable, MAT here not applicable. And if you do not fulfill any conditions, if you claim any deduction which is not supposed to be claimed, then you will have to go with the 30% tax. Is this clear, students? Then for the firm, it is 30%. For the firm, the surcharge is if the income is more than, if the total income is more than 1 CR, then it is 12%. For cooperative society, again, if the total income is between 0 to 10,000, the normal rates are 10%, 10 to 20,000, 20% more than 20,000. 30% surcharges if the total income is between 1 to 10 CR, 7%, and if it's more than 10 CR, it's 12%. But there is again a optional scheme which is also available for the cooperative societies as well. What is that optional scheme? The optional scheme is if it's a manufacturing cooperative society, just like 115 BAB, here also you have 115 BAE for the manufacturing cooperative society with the same conditions, everything same and the same tax rate also. For a normal cooperative society, just like a normal company, you have a tax rate of 25.168% and any other special rate of income which is there, special income which is taxable at a special rate, that shall be continued to be taxed at that rate, but the surcharge shall be 10%. Even in this particular case, the surcharge shall be 10% for the income taxable at 10%. Okay. So this is all about the basics. Any questions you have, any doubt you have, you can ask me. Yes, students. Then the concept of capital versus revenue receipt. Now, why is it important to distinguish between the capital versus revenue receipt? Because the capital receipts are not taxable unless specifically charged to tax, whereas the revenue receipts are always taxable, right? So any, let's say for example, compensation for liquidated damages which are given, those are paid for the sterilization of profit-making apparatus or source, because that is kind of compensating the damage which has happened to the capital asset. So liquidated damages are given if there is damage to the capital asset, if the capital asset is not reached in the proper condition, then in that particular case, it is not in the ordinary course of business and therefore it is a capital receipt. However, it is specifically charged to tax under 28(2). It is specifically charged to tax under 28(2). However, if the assessee has received the liquidated damages for the delay in supply of machinery, then in that particular case, you have to specifically charge to tax under 28(2). Then in case of the any kind of other capital receipt which is towards the one-off gain, then it is considered as the capital receipt. Fine. Now we'll move towards the PGBP students. Any questions you have? Yes, students, please be participative. If you have any questions, you can ask me. Okay. So now we'll go to the PGBP students. Under PGBP, we'll start with section 28. We'll start with 28.1, which is the general charge. What it says is profits and gains of any business or profession which was carried on by the assessee during the previous year. So what do we understand by the profit and gains of any business or profession? So now students, it's important to distinguish between the different heads of income and PGBP, whether it is income from salary or whether it is income from PGBP. If there is employer-employee relationship where you are subject to control and supervision of your employer, if it's a contract of service, then it is income from salary. If it is contract for service, let's say, for example, I'm not subject to any direction and control of my employer, I'm answerable for my own work, then it is income from PGBP. Your TDS is also under 194J, right? In case of leasing of property, whether one can say it is the income from house property or income from PGBP. In that case, you have to remember the decision of the Chennai Properties and Investments case, Supreme Court. If the holding of property and leasing out is the business of the assessee, then it's a PGBP. In case it is not, in case my business is not to lease out the property, then in that particular case, it will be considered as the IFHP. Right? Then you have to also see into the object clause of the memorandum of association to determine what is the objective of the assessee. If the house property is held as stock in trade, then in that particular case, remember there's a section under 23.5 under the IFHP which says there where land and building is held as stock in trade and not let out, then annual value shall be nil for a period of 2 years from the end of the financial year in which completion certificate is obtained. Then whether it is capital gain or PGBP. So income from transfer of a capital asset is always under 45. But if you are doing the trading of shares and securities, if you are doing the sale purchase of the houses that you are constructing, then it is obviously PGBP and not capital gain. However, in case of the FII, these shares held as stock in trade will still be considered always as a capital asset because of the specific provision under 214 of the definition of capital asset. So under the definition of capital asset excludes stock in trade, but for FII, FPI, it says that the shares held as stock in trade would still be considered as capital asset, right? Now, in case of a speculative business is basically contract for sale or purchase of any commodity, which is settled otherwise than by actual delivery or transfer. So basically intraday trading. However, where the company business consists of purchase and sale of shares of the other company, it is deemed to be the speculative business. Exceptions are if my gross total income consists of income mainly under the head IFHP, CG, IFOS, interest on securities, then it is not speculation. Or if my principal business is banking, granting of loans in advance, trading in shares, it is not speculative. Exceptions to speculative transaction are hedging, derivative, forward contract trading in commodity derivative, right? In terms of EPOS versus PGBP, Section 56 says, for example, interest on security will be chargeable under the head EPOS if not chargeable to PGBP. Now, how do we say that whether it is the EPOS or PGBP? So, if let's say, for example, interest on surplus funds are generated, then it is obviously EPOS. However, where interest are generated not from independent source, but it is connected with, let's say, the construction of plant and machinery during the course of the construction, there were some advances given on which interest is generated, it will be capitalized, right? Interest on any margin money which is deposited with the bank to obtain the bank guarantee. This is necessary to undertake the business contract. To keep the margin money to obtain bank guarantee is a need of my business. So therefore, this is inextricably linked to the business and therefore it will be PGBP and not income from other sources. However, if it's surplus fund, then it will be EFOS. Interest on share application money, which is linked with the requirement of raising share capital. When you raise the share capital, you have to deposit the share application money statutorily in a separate bank account. If you generate any interest on that, that is not chargeable as EPOS. It is a capital receipt and has to be reduced from the public issue expenses, right? Because this is not something to earn the interest. Then dividend is specifically chargeable under the EPOS. Even if you do the share trading, the dividend would still be chargeable under the income from other sources. So profit and gains is very, very clear. Then you have to see that under the profit and gains, how do you compute the profit and gains? You have to compute as per the commercial principles of accounting. 145A provides that ICDS shall be used to compute the PGBP, right? So ICDS 1 is the accounting policies. You have to follow the fundamental accounting assumptions, going concern, consistency, accrual. You have to consider the revenue receipts and revenue losses. Loss of stock by fire is, for example, allowed as a deduction. Consider revenue receipts and not capital receipts. Compensation for delayed supply of raw material is a trading receipt, but compensation for delayed supply of machinery is a capital receipt, which is now specifically chargeable to tax under 28(2). Right? Then ICTS 4 provides for the revenue recognition. If it's sale of goods, the sale of goods has to be recognized when there are significant risk and rewards of the ownership are transferred. That is, the seller has no control. And revenue shall be recognized only when there is reasonable certainty of the ultimate collection. For example, escalation prices, export subsidies, those will be recognized only when there is reasonable certainty of ultimate collection. In case of services, if the contract duration is less than 90 days, then you have to follow the project completion method. You will recognize on completion of the project. If the contract duration is more than 90 days, then you will recognize on the percentage completion method. If there are indeterminate dates, then on the SLM basis. Subsidies, grants, cash incentive, duty drawback, loan waivers, concession from the government, you have to recognize in the previous year in which it is received. Royalties will be recognized based on the agreement. ICTS 2, which is the inventory, provides that the valuation of inventory will be at the cost or NRV, whichever is lower. Taxes will be included to the sale, purchase, and closing inventory. You will follow the inclusive system of accounting. Cost, which is their cost, is the cost which is incurred to bring the inventory to the present location. NRV you will calculate, and on item by item basis you will calculate the cost or NRV, whichever is lower, right? Then in that particular case, then ICDS 8 talks about the securities, shares, debt, convertible security which are held as stock in trade. Again, for that it says cost or NRV, whichever is lower. You have to do it category wise and not individual security wise. The actual cost will be calculated based on FIFO or weighted average. It will include brokerage, taxes, fees, and security is acquired in exchange of, let's say, another asset. The cost shall be the fair value of the other asset, right? So you will do it category wise and not security to security wise. Okay. So profit and gains of the business carried on by the assessee at any time during the previous year. Now, no deduction will be allowed for the prior period item and provisions. For the future expenses, no deduction is allowed. For the prior period item, no deduction is allowed. Only exception is 43B. 43B allows the deduction in the year of payment. 40A1, 40A1E. Even when you incur the expenditure, if you have not deducted TDS, we will not allow you the deduction. It will be allowed only when you have paid the TDS. Isn't it? Now, ICDS 10 talks about the provision. Provisions are to be recognized when person has a present obligation as a result of the past event. It is reasonably certain that an outflow of resources embodying economic benefits will be required to settle obligation. A reliable estimate can be made. Only when three conditions are satisfied, for example, provision for warranties, you can recognize the provision. Otherwise, provision for future costs cannot be recognized. For example, provision for gratuity is not allowed as deduction. Provision for doubtful debts is not allowed as deduction. So when you have a present obligation as a result of past event, it is reasonably certain that there will be an outflow of resources and reliable estimate can be made. Now we'll come to the specific charges. 28 to provide compensation for termination or modification of terms and conditions of contract of managing company agency business. So even though the compensation is towards the sterilization of profit-making apparatus, which would be ideally capital receipt, but this is specifically charged to tax. So under 28, when all the revenue receipts are covered, but under 28 2 onwards, you have the capital receipts which are specifically charged to tax. So as I told you, that capital receipts are not taxable unless they are specifically charged to tax. Are we clear? So compensation or liquidated damages for delay in supply of machinery or damages to the machinery are arising out of the modification in terms and conditions of business contract that shall be taxable under 20. 28.3 talks about income derived by trade professional association from specific services performed for its member. So there are clubs, there are gymkhanas which perform the services for its member. Now, how these clubs, gymkhanas function, student, is they take the membership fees from their members and they provide services to the members itself. So I'm collecting the fees from you and I'm providing the services to you itself. So therefore, I am not working for somebody else. I'm taking the money from you and I'm giving back to you itself. So this is known as a principle of mutuality, that one cannot earn profit from oneself. I'm collecting from you. If I'm providing the services to you, then I'm working on the principle of mutuality, that I cannot earn profit from myself, and any income which is there, any excess amount which is there, that shall not be taxable. Now that will not be taxable if it is from the general income, from the general services. If it is a general income from the general services, like I take the entrance fees, I take the membership charges, I take the maintenance charges, I take the transfer fees, all of that will not be taxable on the basis of principle of mutuality. However, in case of specific services, let's say, for example, I'm giving a hall on rent to a specific member. I'm giving a ground on rent for conducting exhibition to a specific company. I am giving the ground on rent to a member for doing his engagement party. That is a specific service. So income from that will be specifically taxable under 28. Any income from general services to all members will be governed by principle of mutuality. That shall not be taxable. However, in case of loss on general services, if there is any deficiency created, then section 44A says that if the expenses are greater than the amount received other than from specific services for general services, because for specific services, any which means you will claim the expenditure. 28.3, you will charge the income. Income means what? Income is the revenue minus cost. So for specific services, any which means you are claiming the reduction of the expense. However, for the general services also, you have a provision under 44A that if you have a loss, if you have income, we will exempt you. It is not exemption, it is just principle of mutuality, which says that one cannot earn profit from oneself and it's not forming part of the taxability. However, in case you have deficiency, then deficiency is allowed as deduction under 44A. That is restricted to half of my total income. That is restricted to but half of my total income. Interest on fixed deposit is not covered by mutuality. That is not mutuality principle. I am not earning the interest from the member bank. I am earning interest on FDF surplus fund. So that is not governed by mutuality. That will be taxable under 28, 3A to 3E talks about profit on sale of duty entitlement license, subsidies from government, duty drawback, all of these capital receipts, but specifically charged to tax. 28.4 talks about value of any benefit or perquisite arising from business or exercise of profession, whether convertible into money or not, or in cash or in kind, or partly in cash, partly in kind. This is the FY 2023 amendment. So even cash benefits, earlier there was judgment of Supreme Court which said cash benefits are not covered under 28.4, but now it says even that is covered. So example, waiver of loan is a benefit to assessor. If loan is waived, that will be taxable under 28. There is also a TDS under section 194R on the benefit of perquisite, which is 10% if the value of the benefit of perquisite is greater than 20,000. So that is also applicable to cash as well as kind benefit. So products received by the social media influencers, if retained by them, then 28.4 is applicable and 194R TDS will apply. Are we clear? Yes or no? Any questions so far? If you charge out-of-pocket expenses, if you have incurred any out-of-pocket expenses and which are reimbursed from your client, you go by airline, you book hotel for while audit, and then the client reimburses you. That is a benefit of perquisite. If you take the invoice of the airline company or the hotel in the name of the client, it is not considered as benefit of perquisite. Conference by the company to explain new products launched to dealers. If company is conducting conference, that is not benefit of perquisite. But if it is arranging a leisure trip along with that conference for their family members, then expenses pertaining to leisure trip will be considered as benefit. Waiver of loan, it is income under 20. But 194R is not applicable. CBDT has clarified that if the loan is waived by the bank. 28.5 is interest, salary, bonus, commission or remuneration received from partnership firm by the partner. That is charged under 28.5. 28.5 is non-compete fee. Again, it is a capital receipt but specifically charged to tax. Some received under the keyman insurance policy under 28.6. If it is received by employee, it is under 17 perquisite. If it is received by a person who is independently doing business, then under 28.5. By a director, right? If it is received by a family member, then it goes to 56 under imports. 28.6 says conversion of stock in trade into capital asset. PGBP on conversion of stock in trade into capital asset is taxable in the year in which the conversion takes place. That will be FMV minus cost. FMV as on the date of conversion. So if it's immovable property, FMV is SDV. If it's jewelry or other capital asset, it is market value. Now, on the conversion to capital asset, if you sell the capital asset, then it will be taxable in the year of sale. Again, the capital gain will be your fair value, what you receive, minus the cost of acquisition. Cost of acquisition is amount which is already taxed under 28.6. Period of holding will be from the date of conversion to the date of sale of that capital asset. If you continue to hold that capital asset for your business purpose, then actual cost for the depreciation will be your cost which is charged, the amount which is charged to tax, the FMP which is charged to tax under 28.6. Are we clear? Now, how will you compute the PGBP? You will take net profit, you will disallow the expenses, add income chargeable under PGBP under 41, less expenses allowable, less income chargeable under the specific heads of income, that will give you PGBP. Under section 30, you have the allowance for rent, repair, taxes, insurance for building, which is a revenue expenditure. Under 31, you have rent, repairs and insurance for the plant and machinery and furniture. Any expenditure which brings in new asset into existence or gives an advantage of enduring nature, such expenditure will be capital expenditure. Expenditure which is incurred to facilitate the business operations to conduct smoothly is not a capital expenditure, that is a revenue expenditure. If through an expenditure a new business comes into existence, new asset comes into existence, there is an advantage of enduring nature, that is a capital expense. If existing businesses continue, that is revenue expense. Even ICDS 5 same said capitalized expense if it increases the performance or future benefit of the asset beyond its standard performance. Share issue expenses are capital expense as it is part of the permanent structure of company. Expenses on bonus shares, it is a revenue expense, it's not capital expense because this is merely a reallocation of funds. Expenditure on convertible debt, again, revenue expense. Then 32 is depreciation. For depreciation claim, you have to fulfill the two conditions. One is asset should be owned by the assessee. Asset should be owned by the assessee. There is an exception. Exception is what? Because in case of lease, the lessor is entitled to depreciation because owner is the lessor. However, the exception is lessee can also claim the depreciation in respect of a leasehold building if he has incurred a capital expenditure on renovation, construction, or improvement or extension of it. Under hire purchase, lessee can claim the depreciation if the asset is eventually transferred to lessee. What is the second condition? Asset should be first owned by the assessee. Second, asset should be used for the purpose of business or profession, including the passive uses allowed. So if the assets are not put to use but ready for use. For example, there are spare inverters which are kept, generators which are kept, which are not put to use, but they are there ready for use. That would be also eligible for the claim of depreciation. Then 32.11 is depreciation on SLM basis for the generation and distribution of power. 31.2 is the depreciation on block of assets. For the generation and distribution of power company, depreciation on SLM basis is on the optional basis. You have to exercise the option before due date of filing the return of income. If you do not exercise, you can go with 32.12, normal depreciation on block of asset. If the asset is transferred, demolished or destroyed, then if the sale consideration is greater than WDV, then you have balancing charge. If you have sale consideration greater than WDV, you have initially the balancing charge, which is the difference between your sale amount minus the W. But if you also have a surplus beyond that difference, then that shall be taxable as capital gain. So if your sale consideration is, let's say, 150, your WDV was 70, which is 80, you will have a balancing charge of 30 and balance will be capital. So balancing charge is nothing but the depreciation which is allowed to you earlier. So balancing charge is taxed under 41. Under PGBP, balance shall be capital gain. under section 50. If sale consideration is less than WDV, then you have terminal depreciation. The amount will be allowed as deduction under 21. Then coming to the block of scheme depreciation, you have the depreciation allowable on tangible, intangible. Tangible assets are building, plant and machinery, which includes ship, vehicle, books, scientific apparatus. Exclude tree bushes, livestock, furniture, building. You have depreciation of furniture. Intangible assets, you have trademark, copyright, whatever, and any other business or commercial rights. Goodwill is excluded. How will you compute the depreciation? WDV, as on the first day of the previous year, additions for more than 180, less than 180 days, less money payable on asset sale or demolished, including the scrap value, less actual cost minus depreciation on asset transfer during slump sale. So that you have to reduce. So actual cost minus depreciation on asset which is transferred during the slump sale will give you the WDV as on 31st March of the previous year. For the newly acquired asset, what is the WDV? WDV is the actual cost, means the actual cost of the asset to the assessee, which is the cost to bring the asset into the existence or put in working condition. So all freight, installation charges, technical charges paid, all of that has to be included. Even the ICDS 5 says actual cost shall comprise purchase price, import duty, taxes, any cost to make ready as the asset for use or bring it into working condition will be capitalized. Interest on loan borrowed will be capitalized till the time the asset is first put to use. So 36(1)(3) also says interest on loan borrowed in connection with acquiring of asset will not be allowed as deduction from the date of borrowing till the date first put to use. Then you will reduce any trial run income, any send-back credit, any cost which has been met by any other person or authority. For example, waiver of bank. If the bank loan is for the capital asset and if the loan is waived, you have under 28(4) taxability. But if it is for a capital asset, you will reduce it from the capital asset. Subsidy, grant reimbursement by the central government, again, that is to be reduced. Assets purchased in cash over more than 10,000, that has to be reduced. So ICDS 7 talks about the government grant. It says you recognize the government grants in the year in which they are received. However, it should not be recognized unless there is a reasonable assurance that the person will comply with the conditions and the grant shall be received. For the depreciable fixed asset, you reduce it from the actual cost. That's what explanation also says to 43 months. Then non-depreciable asset, you recognize as the income over the period of cost of meeting the obligations. Financial support, you recognize the income in the year of receipt. Non-monetary asset, you recognize at the acquisition cost. Refund of grant, if it's a depreciable asset, added to cost. If it's other, then adjust against the unabsorbed amount. Subsidies, waiver, duty drawback. If it is depreciable asset, reduce it from the cost. If it's non-depreciable asset, you have the specific chargeability under 28(4). So you have to recognize it as income. Borrowing cost, any interest, commitment, discount, premium, all those costs which are for the borrowing, if it is directly attributable, you capitalize. If it is not directly attributable, then you capitalize on the proportionate basis. Gain or loss on the foreign exchange fluctuation. Section 43A says that asset acquired outside India or loan is in foreign exchange to acquire the asset outside India. Then foreign exchange gain or loss has to be adjusted to the actual cost at the time of making the payment. At the time of making the payment, you will adjust. So the asset should be purchased outside India. However, ICDS 6 says foreign exchange gain or loss, you have to recognize at the date of the transaction. If it is a monetary item, meaning which is determinable in fixed amount of money, example, cash, receivables and payable. So you have to recognize the M2M gain or loss on the closing date. Non-monetary item, gain or loss not to be recognized except it is covered under 43. Forward exchange contract, premium or discount, you have to amortize over the life of the contract. Hedging, you have to recognize at the time of the settlement. Are we clear? Then in case of the previously acquired assets, what is WDV? So in case of composite income, WDV will be on the notional basis. So what you will do is composite income means you have agriculture, non-agricultural income. So then full depreciation would be reduced from the cost as if it was the normal income. Are we clear? So after reducing depreciation, you will do 40-60%. It's not that you will only reduce 40%. Building which is used for personal purpose and now introduced to business, you will allow a notional depreciation. Sale and lease back, you will consider the cost as actual cost minus depreciation or the price paid to reacquire, whichever is lower. Then in case of the succession, transfer of asset by holding company to subsidiary company, wholly owned subsidiary or vice versa, amalgamation, demerger, conversion of company to LLP, the cost shall be the cost, the WDV shall be the cost WDV of the previous one. In case all the assets in the block are transferred and the block cease to exist, WDV shall be nil. Or if the money is received is greater than, sale consideration is greater than the WDV plus actual cost, then in that particular case, WDV shall be nil and you will have STCG under section 4. All assets liable for depreciation which are ready for use but not put to use, yes, Viraj. Okay. Any question, students? Any doubt? So this is your depreciation. Are we clear? Then we will go for the allowances and disallowances under the PGBP. So for the allowances, you have section 36. For the allowances, you have section 36. You have employment-related allowance, health insurance paid by employer other than cash, bonus or commission paid to employee for services rendered other than in the form of profits or dividend. Subject to that you've actually paid them. It should be not provision, it should be actual payment because this is subject to 43B and subject to 48(2), which is related party. It should be at the fair market. Employer contribution to recognized provident fund or superannuation fund. You should actually pay before the due date of filing the return of income to the provident fund or SAF. So this is subject to 43B. It is also subject to 40A9. So contribution to unrecognized provident fund is not allowed. Only the recognized provident fund or superannuation. Employer contribution to the pension scheme under 80CCD is allowed as deduction, which is 10% of the salary of employee. Salary is salary plus D. Employer contribution to the gratuity fund. Again, you should deposit it before the due date of filing of return of income. It's subject to 43B. Provision for gratuity fund is not allowed. 48(7). 48(9) says contribution to unrecognized provident fund or gratuity fund is not allowed. Employee contribution to the provident fund. So if you deposit the amount before the due date of the fund, which is 15 days from the end of the month, then it will be allowed as deduction. So first it is added to the income under 224(9). Then it is allowed as deduction under 36(1)(5)(a), provided the amount is deposited before the due date of the fund. Are we clear? So bonus paid by employer to the trust is if the trust pays the amount to the employees before the due date of return of income will be allowed as deduction to the employer. It will not be considered as a provision. So even if the bonus is paid by the employer to the trust and then trust pays to the employee before the due date of filing return of income, this will still be allowed as a deduction. Are we clear? In case of the employer contribution, you have to deposit before the due date of filing of return of income. In case of employee contribution, you have to deposit before the due date of the fund and not before the due date of filing of return. Then you will get deduction for family planning, which is 1/5. Then in case of the finance related, you have interest on borrowings. For capital asset, you will capitalize. Discount on zero coupon bonds over pro rata basis. Deduction for the bad debts. It should be for the bad debts, there should have been income recognized. Income is, let's say, for example, considered as per ICDS, but not considered in the books of accounts. And then debt becomes irrecoverable. Then even in that case, the deduction of bad debt is allowed. However, if there is a recovery of bad debts, then in case, let's say, for example, the bad debt disallowed is less than the amount recovered, then in that particular case, the bad debt after recovery, there will be the excess bad debt allowed, which is there, that will be considered as income. And if bad debt disallowed are greater than amount recovered, then in that particular case, the deduction will be allowed additionally under 36(2). Then you have provision for doubtful debts that is only allowed for the specified banks. That is only allowed for the specified bank. For scheduled bank, it is 8.5%. In case of advances given by rural branches, it is 10%. In case of NPA, it is 5%. So this is provision for doubtful debts only allowed for the specified banks. For foreign banks, it is 5%. For public financial institution, 5%. NBFC, 5%. And in case there are actual bad debts, that will be adjusted with the PFT. Deduction for transfer to special reserve for specified entities like financial corporation, banks, cooperative bank, housing finance company. Again, for them, there is a specified deduction, which is 20% of PGBP, amount transfer to special reserve, or 2 times the paid up share capital and general reserve minus amount transfer to special reserve, lower of that. Then you have the other deduction, insurance premium for stock, premium paid for cattle, banking cash, transaction tax, STT, CTT, all of that is allowed as deduction. Under the capital gain, CTT, STT is not allowed as deduction, right? 37 is the general deduction, expenditure not in the nature of section 30 to 36. It should not be capital expenditure. It should not be personal expenditure. It should be laid out wholly and exclusively for the purpose of business and profession. Now, expense which is considered as an offense or which is prohibited by law is not allowed as deduction. Expenditure which is offense or prohibited by law in India or outside India, or which is to provide any benefit to any person which is in violation of any law. For example, giving the freebies to doctors by the pharmaceutical company is prohibited under Indian Medical Council regulation. So such expense will be not allowed under 37. Compounding of offense not allowed. CSR expenditure is not allowed under 37. Expenditure for advertisement in any souvenir published by political party is not allowed as deduction. It is allowed as deduction under 80 GGC if the contribution is other than cash. Interest on TDS, interest on income tax, interest on GST is allowed. Interest on TDS income tax is not allowed. Penalties are not allowed. Legal fees are allowed. Expenditure for directors traveling along with their wife are allowed. Right? So under 40A1, interest, royalties, FTS, any sum chargeable to tax which is payable outside India or to a non-resident, then in that particular case, if TDS is not deducted or TDS is deducted but not paid before the due date of filing of return of income, 100% of the expenditure will be disallowed. It will be allowed in the year in which the TDS deduction is done or made. Exception is if the payee has filed the return of income and considered such income and paid taxes and furnishes CA certificate, then only you will get the deduction. However, the amount should be chargeable to tax. If it's a commission paid to a non-resident agent that is not chargeable to tax, then there is no requirement of TDS and there will be no disallowance. For a resident, if sum is payable to resident and TDS is not deducted, 30% of the expenditure is disallowed. It will be allowed in the year in which TDS is paid. If the consideration is payable to a non-resident for services on which equalization levy is deductible and there is no deduction of that, or it is not deposited, 100% of the expense is disallowed, allowed in the year in which EQL is deducted or paid. If salaries are payable outside India or to a non-resident and the TDS is not deducted nor paid, then in that case, there is 100% of the disallowance. Are we clear? If TDS is deducted but not paid, then in that case, the section doesn't say anything. Also, there is no exception over here that if the non-resident furnishes the return of income, those exceptions are not there. There's a permanent disallowance. And there is no allowance in the next year when you pay it also. This is a permanent disallowance. Then, unlike the equalization levy and the TDS for the resident non-resident. For salary, there's a permanent disallowance. Tax paid on perquisite on behalf of employee are non-deductible. Remuneration and interest to partners of the Provident Fund, it is deductible up to a certain limit. So payment should be to a working partner. Payment should be authorized as per the partnership deed and should relate to the period of partnership deed. Deduction is up to 3 lakh, higher of 1.5 lakh or 90% of book profit. On balance of book profit is 60%. Book profit is net profit as per the P&L account as computed as per the provision of Act. UAD can be set off, but brought forward losses cannot be set off. Amount disallowed will not be also considered as income of partner. Interest is allowed up to 12% per annum on the aggregate of capital, current account, loan account of the partner. Are we clear? Then it should be paid in accordance with the partnership deed and pertains to a period after the partnership deed. Then interest or remuneration to the members of AOP or BOI is not allowed. Then expenditure to any related party, it should be at the fair market value. Then expenditure for the cash transaction greater than 10,000, if it is there, then that is not allowed. Okay. Then what are the exceptions which are covered? Exceptions are payment to the banks, payment to government, agriculture produce, cottage industry, any person who is in village or town which is not served by bank, gratuity or terminal benefit to employee lesser than 50,000 on retirement or resignation, salary to employee posted for greater than 50 days, 15 days at any place or ship or does not who does not maintain any bank account, payment to any agent. On a bank holiday, if you pay more than 10,000, that is still disallowed. Provision for gratuity, as I said, disallowed. Contribution to unrecognized provident fund is disallowed. Then no deduction for M2M losses also, except which is given under the ICDS for the monetary. 43B is deduction on payment basis. So tax, duty, cess, employer contribution to PF, bonus or commission to employee, interest on loans, leave encashment allowance are all covered under 43B. That is, you should pay before the due date of filing of return. For MSME, if you pay beyond the time limit specified under section 15, then it is not allowed. Conversion of interest into loan is not equal to actual payment. When converted loan is paid, only then the deduction will be allowed. Advance paid, if accrual concept is followed, is not allowed as deduction as it is not the expenditure of current. MSME is engaged in the manufacturing or production of goods or engaged in the rendering of services. There are investment requirements. This is the micro enterprise, small enterprise. Also, there are the investment in equipment limits or plant and machinery limit. Section 15, it provides that if there is a written contract, then earlier of date specified in agreement or 45 days from the date of acceptance of agreement. If there is no written agreement, 15 days. So if the time limit under 15 is not followed, then there will be disallowance of the expenditure. If within time limit, in case there is an agreement, so it is as per the time limit under the agreement or within the 45 days, whichever is earlier. So then in that case, 43B not applicable. But if it is beyond these dates, then 43B become applicable and you will get deduction in the year of actual payment. Are we clear, students? Any questions so far, students? Okay, so I have already shared you the question. So let's start solving those. I will open up the question over here. Okay, so first question is, Light Limited, an Indian company engaged in the business of manufacturing of electrical products, has reported net profit of 1.2 crore after debiting or crediting the following items. Engineering fees to ex-INC for the installation of machinery without deducting TDS. However, ex-INC has filed its ITR disclosing this income and paying the due taxes on the same in November 24. Contributed to the Employees Welfare Trust of rupees 2 lakh. Amount of 30,000 was paid to an employee in cash on his retirement. The company had ongoing loan with the Bank of India and is requested to convert interest due of 10 lakhs into new loan, which would be repayable in 5 installments. Assessee has paid 2 installments. An employee, Mr. Raj, was deputed to Northeast for official tour for 20 days. The company paid salary in cash of 1 lakh as there was no bank account there. TDS has been deducted on salary under 192. Amount of 3 lakh paid on incurred on installation of glow signboard for advertisement. The company has paid 5 lakh as regularization fee to municipal corporation to regularize the deviation from sanction plan in construction of factory building. Depreciation based on useful life of assets 300 lakh. Incurred rupees 8 lakh on travel expense of MD and his wife for business trip to UK on invitation by Chamber of Commerce. Provision for gratuity based on actuarial valuation 7 lakh. Actual gratuity paid 1.5. Interest on GST late paid 1 lakh. Contractor fee was 2 lakh. Expense of 5 lakh incurred on issue and collection of CCD and 2 lakh on bonus shares. Provision for doubtful debts 10 lakh and bad debt 2 lakh. Advertisement charge 1.5 lakh paid by check for advertisement published in souvenir of a political party with Election Commission of India. Additional information, opening and closing stock for the year was 55 lakh and this was overvalued by 10%. The closing stock was 54 lakh and was undervalued by 10%. Machinery was acquired from UK for pound 2.5 lakh on 9/9/23. The rate of exchange on date of acquisition was 90. Assessee paid the amount on 5/12/23 when the rate of exchange was 99. Trial run expense was 2 lakh. Custom duty was 20% of purchase price. Assessee financed the machinery through bank loan and interest was 2.5 lakh. Details of other assets are given. Both employer and employee contribution of PF of 5 lakh were deposited on 1/7/24 for month of March 23. Company has employed the employee's salary of which was debited to P&L account. So this is the information which is given. So students, I'm giving you time to solve this question and let's simultaneously take a break also. So I have given you 10 minutes. You can just solve the question and get back. And we'll take a break over here. Ashok ji, break. the sum solving. So we'll go one by one, adjustment wise. Okay. So engineering light limited has first. Let me open up the file so that we can start writing together. Now you get the questions in front of you. Okay. Okay. So Light Limited, an Indian company engaged in the business of manufacturing of electrical product, has reported net profit of 1.2 crore. So we'll start with the first net profit. Is 1.2 crore. Okay, net profit as per P&L. Then it says engineering fees to the ex-INC UK company. It's not VK, it's UK company for the installation of machinery without deducting TDS. However, ex-INC has filed its ITR disclosing this income and paying the due taxes on the same in November 24. So what will be the effect, students? Yes. Tell me what will be the implication over here. Will you allow this expense or will you not allow this expense? Expenses are allowed, Viraj? Yes. Why you think expenses are allowed, Viraj? What is the due date of filing the return of income? Yes. Viraj, you can also unmute yourself and you can speak also in case you want. Otherwise, you can put it in the chat box also. Yes. What is the due date? So due date is 31st October, Viraj. You feel the due date is 31st October. So, in case of a company, the due date is, yes, 31st of October. So, in that particular case, will the expenses still be allowed, Viraj? Do you think will you still allow because he has filed the return in November, Viraj? So, will you consider this as prior to the due date of return filing? No, that's correct, Viraj. So, here we will disallow the expenses. Had it been the case here, Viraj, that this particular company is a company which is subject to the transfer pricing audit. Had it been the case that this company is subject to the transfer pricing audit, in that particular situation, we would have allowed this particular expenditure. But here, since it is, the due date is November 30th, October 30th, then in that particular case, we will not allow the expenses. So just write down over here, add the expenditure which is disallowed. So how much is the amount? We have not written the amount over here. So it's just write down engineering fees of rupees 2 lakh. So add amount of engineering fees. 100% will be disallowed as paid after 30th of October. Is it clear? What if instead of engineering fees, this would have been commission to an agent for sales outside India or commission to a non-resident agent? Whether would you still say it will be disallowed? Yes. Commission to a non-resident agent, will it be still disallowed? Yes, it will be disallowed because no TDS, Viraj, no Viraj. See, commission to a non-resident agent for sales outside India will not be considered as fees for technical services because this is for business or profession carried on outside India. So if you remember, Viraj, in the FTS clause, for a non-resident, FTS will be deemed to accrue or arise in India if it is paid by an Indian resident. However, there is an exception there which says that the FTS shall not be deemed to accrue or arise in India, even if the payer is an Indian resident, if it is for the business or profession carried on outside India. Now, this is for the sales to be done outside India. This commission will not be chargeable to tax. And if I have not deducted the TDS on sum which is not chargeable to tax, there will not be any disallowance. Because 40A1 says that it should be on the sum which is chargeable to tax. So this is not, sorry. Chargeable to tax. Therefore, no TDS under 195 and therefore no disallowance under section 40A. Are we clear? Then contributed to the Employee Welfare Trust, rupees 2 lakh. What will be the implication for this? Employee Welfare Trust, 2 lakh. Yes. Allowed as expenses? No, Viraj. This will not be allowed as expenses. Because contribution to Employee Welfare Trust is unrecognized trust. So under 40A9, there will be disallowance. So this will not be allowed. Even in the earlier case, this will be allowed in the next AY. In the next AY, allowed as deduction, you can write. So a contribution to Employee Welfare Trust is not allowed as deduction. How much was the amount? 2 lakhs. Fine. Okay. Next is amount of 30,000 was paid to an employee in cash on his retirement, whether allowed or not allowed. Yes. Allowed, not allowed? Amount of 30,000 paid to an employee in cash on his retirement. Yes, students. Yes, Viraj, it will be allowed. You're right. Because this is a terminal benefit or retirement benefit which is less than 50,000. So this will be allowed as deduction. So this amount is allowed. So we can write it over here. Allowed as less than 50,000. Because this is the exception to section 40E3. The company had ongoing loan with the Bank of India and requested to convert the interest due of 10 lakhs into new loan, which would be repayable in 5 installments. The assessee had paid the 2 installments during the year. So in this case, what will be the impact? Yes. Whether allowed, disallowed. Yes. How much would be allowed if at all it is allowed? Yes, students. Whether this will be allowed or not, faster. Not allowed, Viraj. Okay, so not entirely 100% will be disallowed, Viraj. So company had ongoing loan of Bank of India and it has requested to convert the interest due of 10 lakhs into new loan. So conversion of interest into new loan is not equal to repayment. So the installments of new loan repaid will be allowed as deduction under section 43B because interest on loan is governed on payment basis. So what we will allow is here, we will disallow 10 lakhs. Ten minus, yes Viraj, you're right. 10 into 2 divided by 5, which comes to 4. So only 4 lakh will be allowed as deduction. So 6 lakh will be disallowed. Are we clear? Okay, next one is, so we will allow only 2 installments, which is 10 minus 10 into 2 divided by 5, which comes to 4. So 4 lakh will be allowed as deduction, 6 lakh will be disallowed. Fine. Next one. An employee was deputed to Northeast for official tour for 20 days. The company had paid salary in cash of 1 lakh as there was no bank account there. TDS has been deducted under section 192. What will be the impact? Allowed, disallowed? Allowed, right. So if it is covered by rule 60D, which is exception to 48(3), right? So in this particular case, you can make the payment if employee is posted for more than 15 days, covered in rule 60D as employee posted for greater than 15 days. So this is allowed. If TDS was not deducted, then 30% is disallowed. But here TDS is also deducted. Amount of 3 lakh was incurred on installation of glow signboard for advertisement. Allowed, disallowed? Allowed? Yes. This is a revenue expenditure. Glow signboards have wear and tear, so they get worn out easily. So you have to incur expenditure in 3-4 years. So this is the revenue expense allowed. The company has paid 5 lakh as regularization fee to municipal corporation to regularize the deviation from sanctioned plan in construction of factory building. Allowed, disallowed? Yes. Disallowed. Capitalization required? No. Viraj, why your capitalization will be required? This is not a capital asset. This is to regularize the some default which has happened. So this is a compounding fee, basically. This is a compounding fee. Regularization fee is to regularize my offense that I have committed. And so therefore, any kind of compounding fees or regularization fee is not allowed as deduction under section 37. So this 5 lakh will be disallowed. Okay. So regularization fee is 5 lakh. Disallowed under section 37. Fine. Next one is depreciation on useful life of asset 300 lakhs. Depreciation on useful life of asset 300 lakhs. Allowed. No, Viraj, will not be allowed. This is depreciation as per books of accounts. So this is not allowed. So depreciation as per books of accounts 300 lakhs will be disallowed. Okay. Incurred rupees 8 lakh on travel expense of his MD and his wife for business trip to UK on invitation by Chamber of Commerce. It is allowed or it is disallowed? Allowed. That's right. So here 8 lakhs on travel expenses of MD and his wife for the business trip is an allowable expenditure. Why it is an allowable? Because it's a practice, common business practice to send the spouse of the MD or directors also. So therefore, it is allowed as a business expense under 27. Fine. Then provision for gratuity based on actuarial valuation, rupees 7 lakh. Actual gratuity paid is 1.5 lakh. Allowed, disallowed? Viraj, you have a question? You can please unmute yourself. Yes, Viraj.
About foreign travel expenses of directors and his wife. Question is if it is not related to business. As in the given question, the expenses are related to foreign travel for on invitation by chambers of commerce.
Right.
But if it is not for business purpose, then is it allowed?
No, if it is not for business purpose, if it's for personal trip that they have gone and company is bearing the expenditure, then in that case, it will not be allowed. See, it's very common, Viraj, for the big companies to send their employees or basically to send their directors along with their spouses. So always it's a business practice that the spouse of the director accompany them and the company pays for them. So it's a business trip for which, let's say, the wife also accompanies the director, then it's a common business practice and it is allowed as a business expenditure. But if it is for the personal travel, then in that case, that will not be allowed as the business expenditure, because one of the condition of section 37 is that it should have been incurred for the purpose of business or profession. Fine. Okay. Then provision for gratuity based on actual valuation of rupees 7 lakh, actual gratuity paid is 1.5 lakh. What will happen in that situation? Allowed, disallowed, how much allowed, how much disallowed? Yes. 1.5 lakh is allowed? Yes, Viraj, you're right. 1.5 lakh is allowed because other is provision for gratuity and 40A7 disallows the provision for gratuity. So, provision for gratuity is disallowed under section 40A7. Actual gratuity allowed. But that should also be paid before the return filing due date. So, we will here disallow the provision for gratuity under section 40A7. 5 weeks. Okay? No, it's 7 weeks, sorry. Then interest on GST late paid 1 lakh. Not allowed as it is a fine or penalty. You are right. So it is not allowed in this particular case. So interest on GST late paid, it is, sorry, interest on GST late paid is allowed. It is not fine or penalty. Penalties on GST is not allowed. Interest on GST will be allowed under 37. Next one is contractor fees was rupees 2 lakh. TDS not deducted with the contention that fees is not paid but is payable. So here you can write it like this. Contractor fee was rupees 2 lakh, which was due to be paid in June 20. Yes. So whether this 2 lakh will be allowed or not, 30% disallowed. You are right, Viraj. So even if the sum is payable and not actually paid, Supreme Court in Palam Gas has held that there will be still disallowance under 40A1A. So it is not only that TDS has to be deducted when the sum is paid, it is to be deducted even if the sum is paid. So TDS not deducted on contractor fees. 30% of 2 lakh 1.5. Okay. So you can write here Supreme Court in Palam Gas has held that TDS is to be deducted even if sum is payable and not be. Therefore, 30% disallowed. Expenditure of rupees 5 lakh incurred on issue and collection of compulsory convertible debentures and rupees 2 lakh on issue of bonus shares. First, we'll talk about expenditure incurred on issue and collection of compulsory convertible debentures. Whether allowed, whether disallowed. Allowed? Yes, that's right. So on compulsory convertible debenture, this is a revenue expense. So this is allowed. 2 lakh on issue of bonus shares, allowed or disallowed? Disallowed? Why, Viraj, do you think it's disallowed? This should be allowed. Because when the bonus shares are issued, there is no change in the capital structure of the company. It's just the reallocation of the profits from the general reserves to the share capital. So here, issue of bonus share, any expenditure incurred on that, it is allowed as a deduction. So if you remember, we had discussed the case law also around this particular point, that in case any capital expenditure is incurred, so any expenditure which is incurred on the issue of the bonus shares, in that particular case, it will be considered as allowable deduction. It is not the case that it will not be allowed as deduction. It is not a capital field item. It is just the reallocation of profits. It is just the reallocation of profit. It is not a capital item, mind you. Are we clear? So when the compulsory convertible debentures are also issued, at that time also it is revenue expenditure. The Supreme Court in ITC Limited has held that even in case of the General Insurance Corporation, Supreme Court has held that this is a revenue expenditure as the capital structure remains the same. So you can write down over here. Revenue expense as capital structure means the same. General Insurance Corporation, Supreme. Fine. Provision for doubtful debt, rupees 10 lakh and actual bad debt, rupees 2 lakh. Provision for doubtful debt. Yes, Viraj, you are right. Provision is disallowed. So this is disallowed. Only for specified banks it is allowed. And actual bad debts allowed subject to the condition that it should have been recognized as the income. It should have been recognized as the income. So under 36(2), this is allowed as deduction. Are we clear? Okay. Opening and closing stock for the year was 55 lakh and this was overvalued by 10%. So what will happen in this particular case? If my closing stock is overvalued, what will you do? If my opening stock is overvalued, reduce the stock? No, Viraj, you will increase the stock. See, opening stock is allowed as a deduction. You take it on the expense side, the opening stock. So means you have taken the extra deduction, right? Yes, you will reduce the stock, right? So which means what? You will disallow the amount. You will add back the amount because you have claimed the excess deduction. So what here we will do is, here we will do 55 lakh into 10 divided by 110, we will add back. So we'll reduce from the stock means we will add back the expense. So opening stock over value. So 55 lakh into 10 divided by 110. Which makes it to 5. Then what about the closing stock was 54 lakhs and was undervalued by 10%. Now closing stock is undervalued by 10%. So what we will do in that situation? Yes. So closing stock was undervalued. Opening stock was overvalued and closing stock is undervalued. Yes. We will add back or we will reduce. And what will be the amount that we will add or reduce? Add back. That's right, Viraj. So we will add back the amount over here because this is undervalued. So my profits have been lesser. So I need to add back. And what will be the amount? 54 plus 10% of 54? No, Viraj. What here we will do is, we will add here 54 lakh into 10 divided by 90. Not 10% because this is 90. You need to make it to 100. So add closing stock undervalued. So 54 lakh into 10 divided by 90. So that makes it to 6 lakh. Are we clear? Next adjustment is, the machinery was acquired from UK for 2.5 pounds on 9th September 2023. It should be 23, not 22. The rate of exchange as on the date of acquisition was rupees 90. The exchange rate on 31st March 2024 was rupees 99. The FCC paid the amount on 31st December 23 when the exchange rate was 99. The trial run expenses was 2 lakh and custom duty was 20% of the purchase price. The FCC financed the machinery to the bank loan of 10 lakh and the interest was 2.5 lakh. The bank waived the loan to the extent of 1 lakh. Now, why this information is given? Because for the depreciation purposes. So, what will be the depreciation on the machinery over here? Please calculate the depreciation on the machinery. Yes. What will be my actual cost first? Actual cost is 2.5 into 90. Okay. So we'll start first with the computation of depreciation. So depreciation on plant and machinery. So actual cost is pound 2.5 lakh into 90. $225 lakh, not 3.5 lakh into 99. How, Viraj? It is 2.5 lakh, right? The actual cost. The assessee, the exchange rate as on 31st March 2024 was 99. So will we take that amount into consideration? Yes. So will we take that amount into consideration? Yes or no? Will you take 9? As per ICDS 99? No, Viraj. So if you go back to the ICDS that we have just now referred, which is ICDS 6. If we go back to ICDS 6, let's go back to ICDS 6, what it says. See, it says for a non-monetary item, which is not determinable in fixed amount of money. So which is like, for example, fixed asset, then it is valued as per the rate on the date of transaction. Gain or loss is not to be recognized on every closing date. So on every closing date, you will not recognize the gain or loss, isn't it? So for a non-monetary item, you will not recognize the M2M gain or loss. Only for a monetary item, you have to recognize the M2M gain or loss. However, for a non-monetary item, there is an exception. What is the exception? Exception is section 43A. Exception is 43A. If it would have been, let's say, for example, inventory, or it would have been, let's say, receivables or by payables. And as on the 31st March, there is difference in the closing rate. Not inventory. Inventory is, sorry, a non-monetary item. If it would have been, let's say, my payable, and there would have been difference in the exchange rate as on 31st March, I would recognize it. I would recognize it as per ICDS 6. However, for a non-monetary item, I will not recognize M2M gain or loss. Only the exception is 43A. What does 43A says? 43A says gain or loss on the asset purchased outside India, or the loan is taken in foreign currency to buy an asset outside India. So the foreign exchange gain or loss will be adjusted at the time of making the payment. Even if you are following the approval concept, at the time of making the payment, you have to adjust the foreign exchange gain or loss. Are we clear, students? Yes or no? So therefore, in this situation, if I go back, here, I have acquired the asset outside India. So means clearly my 43 is attractive. So then in that particular case, I will make an adjustment for the 9 on the date of payment. 31st March is not important for me. The assessee paid the amount on 31st December 2023 when the exchange rate was 99. So as on 31st March 24, the exchange rate has remained the same. That's fine. I'm not concerned with that. I am concerned with the 31st March 2023 when the payment has been made. So if asset is acquired outside India, if the asset is acquired outside India, then if there is increase in liability, here there is increase in liability, or you can just write there is increase in liability at the time of payment. So you will add 2.5 lakh into 9. 22.5 lakhs. Now, let's say for example, if this was acquired from India, let's say instead of asset acquired from UK, asset was acquired from India. Would 43A be applicable? Answer is no. So section 43A is not applicable in that case. And as per ICDS 6, the 9 pound will not be adjusted, or increase of 9 pound will not be adjusted as M2M gain or loss, as it is non-monetary item. As it is non-monetary item. Are we clear? So, for example, if I give you another adjustment over here, I give you another adjustment over here. This is one point. The other adjustment is if my payables in foreign exchange were rupees 1 lakh. These were recognized at exchange rate of 1 USD is equal to 80. As on 31st March 24, 1 USD is equal to rupees 90. So what will you do in that situation? Will you recognize the 10 gain or loss, or will you not recognize it? What will you do in this situation? Yes. Shall we recognize the 10, or we will not recognize the 10? Yes. What will happen in this case? We will recognize the 10 as this is. So, rupees 10 . So what will you do is 1 lakh into 90 divided by 80. you will recognize, or 1 lakh into 10 divided by 80, you will recognize as M2M loss as per ICDS 6, as it is monetary item. So this is a monetary item. You will recognize as per ICDS. If it's a non-monetary item, you will not recognize unless it falls under 43. Are we clear, student? Okay. Then it says the next adjustment is the trial run expenses were 2 lakh. We will add trial run expense. Fine. Then it says custom duty was 20% of purchase price. So we'll add custom duty also. So as per Challapalli sugar mill case, whatever expenditure are incurred to bring the asset in existence, that is considered as part of the actual cost. So 20% of 225 lakh. 45 lakh. We will add that. Then the assessee financed the machinery through the bank loan of 10 lakh and the interest during the year was 2.5 lakh. What will happen in this case? Will we add the interest? Will we not add the interest? Yes. Interest will be added, right? So interest will get added over here. So we will add the interest. This is as per proviso to 3613 and the explanation to 43.1. Explanation 8 to 43.1. So this is as per explanation 8 to 43.1 and proviso to section 36.1. How much is my interest, student? My interest is 2.5. Okay. Then the bank waived the loan to the extent of 1 lakh. What will happen in this case? Reduce from the asset. Yes. So as per ICDS 6, you will reduce from the asset the bank loan waived. So bank loan waived, ICDS 6, 1 lakh. Now had it been bank loan waived for loan taken for business purpose and not for capital asset. If I have, let's say for example, bank loan taken for working capital of rupees 5 lakh and bank waived of rupees 2 lakh. What will happen in that situation? What will happen to 2 lakh? This was a case of bank loan for the capital asset, therefore you reduced from the capital asset. But what about the bank loan taken for working capital and bank waived off rupees 2 lakh? What will happen in that case? Yes. Will you reduce from the capital asset? What will you do? Whether it's a capital receipt, what will you do in that case? Yes, yes. So in that particular case, this will be considered under 28(4). So this 2 lakh will be my income. So waiver of bank loan revenue, sorry, not revenue, charge to tax under section 28(4). However, as per CBDT circular, no TDS by bank under section 194. So though it will be charged to tax under 28(4) specifically, but there would not be any TDS by the bank under 194R as per the CBDT circular. Are we clear? Okay. Now that brings us to the again actual cost of the asset. So what will be my actual cost? It brings me to 296 lakh. Now what will be my rate of depreciation over here? Yes. What will be my depreciation over here? Yes. At what percentage? At the rate of 15%. Yes, right, Viraj. It shall be at the rate of 15% because assets are used for more than 180 days. More than 180 days. So therefore, it's 15%. So that will be 44.4. What about the additional depreciation? Will it be available? Will additional depreciation be also available over here? Yes. Or only the normal depreciation will apply? Yes. Why additional depreciation will not apply in this case? You read as the first line. What does it say? Yes, Vedad, you're right. It's available to the manufacturing. So what does it say? What is the first line? Yes, yes. Whether it is available to a manufacturing company or not. It says Light Limited, an Indian company, is in the business of manufacturing. So therefore, here it will be also available to this company. So here it is, additional depreciation at the rate of 20%. So 296 into 20%, 59 point. Then details of the other assets are given. Computer installed in factory. So what is the rate of depreciation over here? Yes. Yes, 40%. Will there be additional depreciation? Yes. Will it be available or not? Yes, it will be available. So computer installed in the factory. Here, first of all, there will be the normal depreciation, which is the 40% rate, which is there. There is no problem in that. Plus, since these computers are installed in the factory, there will be additional depreciation of 20%. There will be additional depreciation of 20%. So here I will have normal depreciation at the rate of 40 plus additional depreciation at the rate of 20. How about printers and scanners? What will be the rate of depreciation on them? On printers and scanners, what will be the rate of depreciation? 40. That's right. So, Viraj, it is 40. You are right. As like computer. Fine. Computers installed in office. So, I understand there is this normal depreciation at the rate of 40%. Whether additional depreciation will be available over here? Whether additional depreciation will be available? No additional depreciation. You're right. So additional depreciation is not available on the office appliances. On the office appliances or plant and machinery installed in the office premises. So in that case, there is no additional depreciation which will be available. Factory building. What is the depreciation over here? Depreciation on factory building. 10%. You're right. So here it is 10%. Office equipment. %15 on office equipment. So on office equipment, yes, you are right. It is not 50. Sorry, you are not right. It's not 15%. It is 10% on office equipment. It is not plant and machinery. It is falling under the furniture and fixture. So this will be 10% and not 15%. EPPX and mobile phone. Office equipment is not plant and machinery. Only on plant and machinery, you have the rate of 15%. Are we clear? Yes. On EPPX and mobile phone. Yes, how much it will be on EPPX and mobile phone? It is 10% and not 15%. EPPX and mobile phones are again not plant and machinery, Viraj. So here also it shall be 10% and not 40% or 15%. Are we clear? Yes. So what will be my depreciation over here? What shall be my depreciation over here? It is 40% and 20% on the computers installed in factory. So So 1.2 on computers, then 40% on the computer installed in office, 10% on office building, 10% on office equipment, EPPX and mobile phone, it is 10%. So that makes me to 56.7. How 57.1? It is 56.7, right, Viraj? I'm getting 56.7. $57.1. Yes, you're right. So here my depreciation as per books of as per Income Tax Act is 57.1. Fine. Then the employer and employee contribution of PF of rupees 5 lakh were deposited on 1 June 2024 for the month of March 2024. For the month of March 2024. So what will happen first to the employer contribution? Will it be allowed as deduction or will it not be allowed as deduction? Allowed as deduction? Yes. So the employer contribution which is there, the employer contribution that has to be allowed as deduction as per the due date of the return under 139(1). So that has to be deposited as per the due date of the return under 139(1). So the employer contribution which is there, if you see under the disallowances or under the allowances under PGBP, what it says is under section 36, it says that the employer contribution will be allowed as the deduction if it is contributed to a recognized provident fund under 36(1)(4). However, it should be deposited before the due date of the return of income. So, the employer contribution allowed if deposited before the due date of return of income under 139(1), 36(1)(4), read with section 43. What about the employee contribution? What about the employee contribution? whether employee contribution will be allowed as deduction or not. Whether employee contribution will be allowed as deduction or not. Yes. Employee contribution of rupees. Employee contribution, Viraj, has to be deposited before the due date of fund, which is 15 days from the end of every month. So here, employee contribution shall be disallowed or employee contribution is income under section 224(10). Employee contribution is considered as our income under section 224(10). Is considered as income under section 224(10), students. So under 224(10), it is considered as my income and will be allowed as deduction only when I deposit to the fund before the due date of the fund, which is 15 days from the date of fund. Are we getting this particular point? So therefore, employee contribution, since it has not been deposited to the due date of fund, before the due date of the fund, so then in that particular case, it will not be allowed as deduction under 3615A. Okay, so here how you will present your answer is employee contribution, how much it is? 5 lakhs. Less deduction under section 3615A as not deposited before the due date of fund. For employer contribution, you have to deposit before the due date of filing of return of income as per 43. For employee contribution, you have to deposit before the due date of fund. If you do not that, you will not get any deduction under 3615. 43B does not cover employee contribution. So 5 lakh will be added to my income. Now students, let's assume in this particular situation, if the amount is paid to a trust as employee contribution, if instead of I paying the employee contribution as bonus, sorry, not as bonus, if I pay the employee contribution to the recognized provident fund, I am depositing it to a trust. Then in that particular case, will it be allowed or disallowed? Yes. So let's say, for example, employee contribution paid to a trust of rupees 2 lakhs. Will it be allowed or will it be disallowed? I'm not paying it to a recognized provident fund, I'm paying it to the trust. Not allowed. So this will be disallowed under section 40A. So only the employee contribution or employer contribution to RPF, SPF or the gratuity fund is allowed. Subject to deposit before the due date of fund. Are we clear? So in this particular case, this will not be allowed as deduction under 40A(9). Now let's say, for example, here I make another adjustment. Let's say Light Limited contributes, let's say Light Limited contributes 20% of the salary of employee, 20% of basic salary under the statutory pension scheme under 80CCD. 20% of basic salary under the statutory pension scheme under section 80CCD. And let's say, for example, in this particular case, the salary which is there, the basic salary for the employee will be, let's assume, is rupees 10 lakh. Let's say the basic salary is rupees 10 lakh. And DA is 40% of salary. So in this case, what will be my deduction? What shall be the deduction to the employer, to Light? Yes. Yes, students, what will be your disallowance? Yes. 2 lakhs. So here, what is my basic salary?
From your calendar, Sid, a reading with Harsha.k.
Salary is 10 lakhs. My DA is 40%, which is 4 lakh. So 14. Now, if you look at the 3615A, sorry, not 3615A, 3614A. The employer contribution to pension scheme is allowed as a deduction under 80CCD, and deduction is 10% of salary of employee, which is salary plus DA. So, deduction under section 3614A is restricted to 10% of salary, which is basic plus D. So, which is 1.4 lakhs. How much Light Limited is contributing? It is contributing 20%. Which is coming to 10 into 20%, 2 lakhs. So disallowance under section 40A(9) is 0.6 lakhs. So there will be a disallowance which will be created under 40A(9), which is basically in relation to the amount which is paid over and above this particular statutory amount which is given under 3614. Isn't it? So under 40A9, there will be a disallowance which will be made. Isn't it? So as I had told you that you will not get a deduction beyond this particular amount, which will be considered as contribution to unrecognized provision. Okay, so excess amount will get disallowed. Fine. So 2 lakhs will not be allowed. It is only 1.4 lakh Viraj will be allowed. Are we clear? Last adjustment is, let's say for example, Light Limited pays rupees 1 lakh as bonus to trust for paying to its employees. The trust pays the bonus to employees before 30th September. Whether this will be allowed as deduction? Yes. Whether this will be allowed as deduction? Allowed. Yes, you are right. So bonus paid to trust, and if the trust paid to employee before the due date of return of income as per Shasun Drugs Limited case, this will be allowed as deduction. So bonus to the employees is allowed as deduction under 3612, and this will also be allowed as deduction even if it is paid to trust. So this is allowed as deduction under 3612. Shasun Drugs. Fine. Okay. Now coming to the last adjustment of 80JJEE. The company has employed the employees. The salary was debited to P&L account. Date of appointment is given. First we look at the first employee, number of employees 1. Salary per month is 22,000 and it is paid in cash. The employees are regular employees. So whether 80JJAA will be given? Yes. Whether you will give 80JJAA benefit. 80JJAA is given for the new employees, right? Whether you will give no, because this salary is paid in cash. So if the salary is paid in cash, you will not give any deduction over here. Okay. So here I will write no as salaries in cash. Plus I will disallow this particular expense also. Plus I will disallow this expenditure also because this is debited to P&L account. It is in cash. So 22,000 from the month of July. So July, August, September, October, November, December, January, February, March. For 9 months, I will disallow 22,000. So salaries in cash disallowed under section 40 greater than rupees 10k, right? So 22,000 into 9 months, 1.98 lakhs. Okay. Then next one is 4 employees, 11,000 per month, account pay check. The employees are regular employees. So will 80JJAA will be available over here? Yes or no? Available, right? So here, this is available. So yes. Then next year, again one employee joined in August, 25,000 salary paid by ECS, and these are casual employees. Now here you can just write down casual employees do not participate in PF while regular employees participate in PF. So whether 80JJAA available for these employees, for casual employees? Yes, 80JJAA available. So since these employees are not participating in PF, whether you will give them the benefit of 80JJAA, that is the question. Yes, students. Faster. Yes, yes. Whether you will give or not give. Amount is 25,000. That is also correct. So 80JJAA is available when the additional employees are higher. But it excludes certain employee whose salary is greater than 25. Here it is exact 25. It is not greater than 20. Employees who are covered by EPF. So employees who are not covered by EPF or not covered by RPF, they are excluded from the definition of the employees. So in this particular case, your 80JJAA benefit will not be given. It is not exceeding 25, it is exact 25. So that is not the point over here. It is not covered as employees not participating in RPF. Then October employees, 30,000 paid by ECS and regular. So whether in that particular case covered or not. It will not be covered as the amount of salary is more than 25,000. So here not covered as salary greater than 30,000. Last month, employees hired in October 22 last year, 10 employees. Salary per month was 10,000. Mode of payment was ECS and these were regular employees. Whether covered under 80JJAA or not. Whether you will give for them 80JJAA or not. No, as employee in last year, no, Viraj. So in the last year, they were employed for less than 240 days. So if the employees are employed for less than 240 days in the last year, you will not give the 80JJAA deduction in that year. So therefore, no 80JJAA claimed in last previous year. And the provision says, the provision here says, if you go back to this provision, it says that if the employee is employed for less than 240 days in the current year, but in the succeeding previous year, he is employed for more than 240 days, then 80JJAA will be given in the subsequent previous year. It will be given in the subsequent previous year. So, therefore, deduction in current year as employee in current year or greater than. Are we clear? So, in this case, the 80JJAA will be available for this particular. In case it would have been a leather company, in case it is a company which is engaged in the business of leather manufacturing, so what are the number of days which are considered for them? Instead of 240, what are the days which are considered for them? Yes. Yes. So for manufacturing of footwear, leather products and apparels, it is 150 days. So for manufacturing of apparels, leather, footwear, it is 150 days. So if the question would have said it is engaged in the manufacturing of leather or footwear, it would have been 150 days. Are we clear? So finally, my deduction under section 80JJAA will be, see, I will compute my total income over here. Sorry, total income over here. And I will give less deduction under section 80JJAA. Now, what is my deduction under 80JJAA? My deduction under 80JJAA is 30%. My deduction under 80JJAA is 30% of the additional employee cost. So in this particular case, what is my employee cost? So 30% of, what are the amounts that I have to take? 11,000 into 4 employees into 9 months. 9 months. Plus this 10,000 into 10 employees for 12 months. So, $4,78,800. This is my 80JJAA. Are we clear? There was one more adjustment which was there, which was advertisement charges rupees 1.5 lakh paid by check for advertisement in the souvenir of a political party registered with Election Commission of India. So that will be disallowed, right? So advertisement charges for political party souvenir 1.5 lakh will be disallowed. And that will be allowed as deduction under section 80 GGC 1.5 lakh. Fine. So this was a comprehensive sum covering all the adjustments that we could for the business profession. Any questions so far? Any doubts, any questions? I have already given you the next question, and before you come for the next class, please see the sectorial deduction in the next class. We will solve the questions on the sectorial deduction, which is 33 ABT, coffee, rubber development, scientific research, all of those questions. We'll revise around that area. So I would request you to please read and revise and watch the lectures around those topics. In case there are no questions, I think we can stop here. Okay, if there are no questions, I think we can close over here. Yes. Thank you.